Good evening, my friend. Welcome to the new stock analysis video. In this video, we will analyze this company called the Estée Lauder Companies Incorporated with the stock ticker EL. And the reason why I chose this company is because today they were actually paying the dividends. And also, if we take a look at the 10 years chart, we can see that it's quite good, because if I would buy, let's say, this stock in March 2014 and then sell it right now in March 2024, so basically 10 years after that, altogether I would more than double my investment, because you can see that the price return over the 10 years was 100 and almost 14%. But if I would buy this company, let's say, each month for the same amount, let's say 100 euros, basically with dollar cost averaging, altogether in all those 10 years I would have around 8% profit. And as you can see also here in the 10 years chart, the price started to decline significantly since December 2021. And right now, since November, which is maybe 6 months before as we are right now, the price started to slowly get up. So let's take a look at the financials and let's try to find out if maybe there are some hidden opportunities in this company. And as always, we will analyze the stock with the help of my Excel table. And here I made a summary out of the most important financial statements, meaning income statement, balance sheet, and cash flow statement. And for this video, I decided that I will change the script a bit, because unfortunately you don't watch the whole video of the stock analysis, because of course it gets a bit boring. So I decided that I will maybe make a quick summary so that you watch until the end, that you then see if you should buy this company or not, because that's helpful for you, okay? Because your attention span is kinda low, so let's make this as quick as possible. And we will start with the income statement. Income statement, as you can see, I analyzed the data for the last 10 years, because this will give us better perspective of the development of the company, how good the management is, what they are doing, how their future might look like, and so on and so on. We basically have better perspective if we analyze for the last 10 years, and that's always the fact, okay? And as you can see here in the income statement, we basically decided that we have 4 buy points and 3 sell points, which means that overall income statement should be marked as a buy, because we will always decide based on the data whether we should buy or sell the stock. And now we come to the balance sheet, and in the balance sheet we have 3 sells and 3 buys, which means that we have 50-50. And when we evaluate the company, we want to be as harsh as possible, because this will give us a bit more free room, so to say. This will give us a better margin of safety, so that in case we are wrong, then we still have, just in case, a bit of more space to basically decide whether we should buy or sell, okay? So with that being said, we will mark the balance sheet as a sell. And now we come to the cash flow statement, and here we have again 2 bullet points which are marked as buy and 2 which are marked as sell. So again, we want to be as harsh as possible, so I marked cash flow statement as a sell as well. Okay, and now let's come to the final evaluation. I think that this company has a good total revenue and also a good gross profit, and even better, it has an outstanding gross profit margin. As you can see, in the all 10 years that we analyzed, it was more than 40%, because we want to be gross margin to be more than 40, okay? And here it was around 80, but then unfortunately it lowered up until 71, but still it's more than 40 significantly, so we mark that as a buy, which is amazing. And then also when we go to the balance sheet, we see that they have quite good return on the total equity, because preferably we want this to be more than 10%. And unfortunately, as you can see, the debt to equity ratio is absolutely horrible at the moment. Preferably we want this to be lower than 50, or at least lower than 60%. But as you can see here on the chart, it's around how much? 120, 130%, which is absolutely too much. We cannot do that. We cannot allow that. The good thing is also that retained earnings are growing through the years, and this is a good sign because that means that the company reinvests the money back into itself instead of paying it as dividends to the shareholders, which is amazing because that means that the company is thinking into the future as well. And now we come to the cash flow statement, and cash flow statement shows quite some good news because the capital expenditure is growing through the almost all years, which basically means that the company is always investing money back into itself to buy new machinery, new land, new equipment, basically to invest into the company so that they can grow bigger and spread themselves, okay, which is absolutely amazing. And also the stock dividend, it's also growing through the all 10 years, like significantly, which is a very nice sign, especially if you are a dividend investor like I am. But unfortunately, bro, P/E ratio and intrinsic value are completely crap. Because if you see here right now, I calculated the P/E ratios of 8 companies that are competitors of this company, and overall, bro, their average P/E ratio is around 40, okay? But this company not only has it more than 50%, which is absolutely shit because we want to have companies with P/E ratio lower than 15. Not only that, but the P/E ratio of this company, bro, is 103, which means that you would have to invest 103 euros for each 1 euro of profit. That's completely overpriced. That's a complete no-go. Here you have sell, but this should be even more than sell. And also intrinsic value tells us what is actually the fair price of this stock based on the dividends, based on the cash flow, based on the expected growth. And as you can see here, the recommended price for this stock should be around $121. And right now this company, as I was making this video, is trading around $151. Maybe if we take a look at the actual data, we can see that today it was trading around 159.75 cents, which is still completely overpriced. So bro, with that being said, final decision is definitely a sell because this company is severely overpriced despite the good ratios. With that being said, bro, do the hard work and see you on top of the world.